Hey everybody, hope everyone's doing well. This is the overview of the Emini 5-minute chart for Wednesday, October 9th, 2024. And before I start the review today, I want to talk about a question someone asked a few days ago. And if I pull it up, it was actually over a week ago at this point. So I apologize for the delayed response. So let me see, this was September 27th. So here's the day, and the person asked, why would there be trapped sellers below bar 6? Because it's a low 2. And they said, just wondering, since it was a bad sell signal bar and the context didn't seem great for bears. And what this person is asking makes a lot of sense, and that's all true. Why are there trapped bears below bar 6? In other words, who was selling below bar 6? We have a gap up, a couple of legs down, second reversal. Who in the world would sell below bar 6? It's a bad signal bar, it's a bull reversal bar above the moving average. And it's a really good question. And it's a question that I've asked Al and Brad several times in the past. So there's a few ways we can break it down. And one way to think about it, so in order to answer it this way, we need to think about the situation. We need to think like an institution. So as retail traders, it's easy to get caught up in the details. And as an individual, you just don't think like an institution does. And by the way, when I say retail traders, I'm referring to probably everyone watching these videos. And a retail trader is just an individual who trades their own capital rather than with institutional money. And, rather than working for an institution, they work for themselves. So there's no boss or risk manager or anyone like that. So a retail trader is typically just someone who trades their own money from home. So first of all, let's remember that in order for a trade to take place, there has to be a buyer and a seller. So there has to be an institutional bull buying and an institutional bear selling on every tick. That's true on every tick. And we assume that institutions are profitable over time. Otherwise, they'd go out of business. So that means on every tick, there's a bull and a bear trading a system that has been proven to be profitable. So when it comes to institutions, the reason I said we have to think like institutions, and most retail traders don't, institutions have regulatory liquidity requirements to fulfill. And to state that in simple terms, they have orders to fill. And you think about an institution, they have hundreds of millions of dollars or billions of dollars even to trade. And most of them don't know and apply the information that Al teaches. And with that said, you read about this in Al's books. I think it's actually in the Always In chapter. He says some institutions, like mutual funds, remain fully invested long, and others, like hedge funds, will simultaneously be in long and short positions. I want to make sure I'm not getting too far off track here. So, for one thing, this will all make sense. I'll tie it in together. A retail trader is more flexible than an institution. And an institution has orders to fill, and that's important to remember. So, if an institution just has orders to fill, and they can use a 50-point stop, a 100-point stop, then does it really matter where they enter? If the market is neutral most of the time, and you've heard Al say this, 90% of the time, a trader can buy or sell at any point. And if they scale in, they have, if they manage their trade correctly, there's an 80% chance they can make money. Plus, think about it this way. There are hundreds of banks and hundreds of thousands of very smart people who are all buying and selling for unknowable reasons. And because of that, the typical edge is going to be really, really small. The spread is always going to be really tight. So again, if you look at a chart, most of the time it's going to be fairly neutral between that 40 to 60% band that Al talks about. And that's why, in that 40 to 60% band, that's where traders can buy, scale in, lower, make money, sell, scale in higher, make money. So just look at this example, bar 6. Trader sells below bar 6, and let's forget about the reason. Let's just say, for any reason, even a mistake, a trader sells on a stop order 1 tick below bar 6. They get filled on 7. They take a measured move of this trading range from bar 1 to bar 5, and they use that measured move to put their stop. And they say, okay, I accidentally sold, but I can trade my way out of this. Or they had a reason, doesn't matter the reason. A trader sells below 6, they're willing to scale in higher, they scale in, sell more above bar 1. And if they did that, they would have been able to avoid a loss on bar 9. And if they held the trade and relied on their wide stop up here, you can see the market did not reach it. And eventually, it took a while, but they would have been at a profit later in the day. You can also consider different time frames. So, let's look at a 30-minute chart of this day. So here's bar 1. So a 5-minute chart, 6 bars in the 30-minute bar. We're talking about bar 1 right here on this 30-minute chart. A trader sells the low tick of this bar, let's say. But the logic, at one point this is a bear bar on its low. They see a big sell-off, deep pullback, but up to this point, this should get a second leg down. 1, pullback, 2, and we'll probably fall down here. With that logic, a trader can sell anywhere during this bar, so maybe they happen to get filled below bar 6 on the 5-minute chart. But if they use a wide stop up here above yesterday's high, again, you can see the stop would not have been run, and if they held on to the trade, look how close they came. And this is their entry up here. So they got that second leg. We got a higher low, double bottom in this case. And you can take that time frame argument to an even higher level. There's traders trading daily charts, weekly charts, and they don't know what's happening on a 5-minute chart, and they don't care. There's traders trading without a chart, and there's just so many countless reasons that traders are trading, buying and selling. It's just impossible to know. But again, if we look back at the 5-minute chart logic, we can think about low probability trades. A trader sells below bar 6. They know it's a low probability trade. But what offsets low probability trades is good risk reward. So let's say a trader sells below 6, stop above 6, and they're hoping the market just plunges down. Maybe 3 pushes up, high in a trading range, we get a vacuum test down here. So they'll sell here with a tight stop, knowing that they're going to lose the trade most of the time. But if they win the trade 20 or 30% of the time, the big profit offsets the bad probability. So to summarize all of this, traders are trading for more reasons than we could ever conceive. And if you just look at any bar, let's look at bar 6. And look at the up volume and the down volume on the data tip. Bar 6, we have about 4,400 contracts on that one bar. Look at bar 7, the big outside up bar. That's more like 25,000 contracts on that one 5-minute bar. So again, there's so many contracts being traded for so many unknowable reasons. and institutions just have orders to fill. So that's one way to think about it. And I hope that answers the question. And for anyone else who listened to that, thanks for listening, and I hope that helps. So for today's review, here is the daily chart. We had a bull trend bar yesterday, and it was a fairly strong trend. Look at the 5-minute chart, a couple of legs up, tight bull channel. But the context isn't great, because most of the time in a tight trading range, you get bad follow through. I thought if we were to go higher, let's think about it. A possible second leg trap, and then a gap up and a bull bar. We know the momentum was pretty decent for the bulls going into the close of yesterday. Are traders going to sell directly above the bar, or are they going to pull their orders and look to sell higher in the trading range? And that's what causes vacuum tests in trading ranges. If a bear knows the market's going to test the top of the range, why would they sell here when they can sell at a better price? And if a bull knows we're going to get a test of the top of a trading range, why would they take profits here when they know they can probably take profits a little bit higher? So I thought sellers above yesterday, but not directly above, we might have to go higher to find sellers. And if we were to fall below the low, probably buyers below. It's a bad sell signal bar at the bottom of a tight trading range. And here's today, the 5-minute chart. I have yesterday's high in blue, and I have the September 26th high, which is this bar, the top of the trading range, on the daily chart in magenta. So we scroll back a little bit, and we look at this channel coming into the day. It's a tight bull channel. Now it's tough when you know the higher time frame context is in a trading range. You don't know if this is 2 legs up in a trading range. But when you look to the left, you know that these bars are closing above a lot of bars to the left. So the market is trending here. We're getting higher highs, higher lows, and until there's a breakout below a major higher low, the market is considered a bull trend and always in long. So here's the first 6 bars of the day. And so far, we have 2 bear bodies, but they're both dojis, and only one closed below its midpoint. Bar 6 did not. So right away, the selling pressure in here, not very good for the bears. Bears hoping we have a double top and a major trend reversal, and it's possible. Bull trend, trendline break, retest, looking for sellers here. Look at bar 7. Is that a good sell signal bar? Not really. It's after a 5 or 6 bar bull micro channel. Odds are the first reversal will fail. It's a doji. The signal bar is weak. There's probably buyers below here. The bears need at least a second reversal, and this trendline break wasn't all that strong. The bears could not even get 1 bar completely below the moving average. And what about selling here? We triggered the sell on 8. What about selling below 9? You're getting more bull bars, and the market's continuing to channel up. It looks like a leg in a trading range, but there's one thing to always look for, and that's gaps. Look at the bear bodies. No overlap here. Market's trying to overlap, but it's sort of subtle, but we just continue to grind up higher and higher. And all of a sudden, we have, even since over here, but if you just look at today, 10 or 15 bars above the moving average, tight bull channel. Whenever the market is in a tight bull channel, you only want to look to buy. So there's no reason to sell through here. And then all of a sudden, you get a bull breakout 18, 19. Now we know that's either exhaustion or a measuring gap. We know it's not a breakaway gap or a breakout gap because the bull trend, you would say, started down here, bar 45, yesterday. If it is exhaustion, we expect a retest. We expect the market to go sideways, not necessarily reverse and get a test of the 18 low. But the danger is we could have a measuring gap. we can go all the way up here. And again, just judge the selling pressure today. Here's bar 1. Where have the bears had one bar closing near its low? They haven't. Where has a stop order bear made money today? They haven't. So even if a bull bought for any reason, just trailed the stop 2 points below a bar, they would not have been stopped out up to this point. And these are all signs of a strong bull trend. Very small pullbacks, open gaps, really just not many bear bars at all. And this is what happens. When everyone realizes it's a small pullback trend, the market can go really far, really fast. And there's that measuring gap, measured move. And you can see we got there. You can see the market also broke straight through the top of the trading range, hesitated briefly for a bar, but then had a really strong breakout. And once we hit the measuring gap, we finally got some profit taking. In general, when the market is this climactic and so far from the moving average, usually it's best to just exit longs below a bar closing below its midpoint. So you get a bar like 30, probably just exit longs below it. If not, certainly get out below 31. We can get a deep pullback to the moving average and probably test this breakout point. 24 was a bad stop order buy, and the high of 24 will likely get retested and then become support. A couple of legs down, 1, pullback 2, but whenever the pullback between legs is not really significant, just like here, there's not really a major trendline break here, the risk is real that these 5 bars are all just one leg on a higher time frame. So even though we see 2 legs on the 5-minute chart, the channel is tight enough that it's just a breakout on a higher time frame. This might be one of 2 bigger legs, so maybe 1 pullback 2. Big enough bar 35. You'll probably get a second leg, but it's probably minor. At this point, big up, big down, the market is probably in a trading range. Probably buyers below 35, maybe buyers at a 50% pullback of 35. And you can see what happened there. There's 50% of the bar, buyers there, but those buyers are scalping because, again, this is strong enough to be one leg. This might be a 2-legged pullback before a second leg down. So we can get above bar 35, but that might be all the bulls look to get. We get above 35, and then everybody sells for the second leg down. Now we're getting a second leg, but after such a strong bull trend, if you're selling a second leg that's probably low in a trading range, it can be dangerous. And then you get bad follow through, 42. Not good for the bears. And then more bad follow through, more sideways. So if you're a bear and you sold, let's say you sold the close 41, and then you get bar 42. The sell the close bears might use 43 to exit at break even, and that's what they did on 44. Now you have an implied second reversal, 44, 1, 2. It's also a second leg, 1, 2. Strong bull trend. The best the bears can hope for is a trading range. This is unlikely the start of a bear trend. So bulls will buy, scale in lower, knowing we'll probably retest the top of the trend. There's a stop order buy above 44, good entry bar 45. More follow through. This is strong enough to get a second leg up. Buyers below for a second leg. A little bit of an endless pullback, but this is still probably minor. And then we get a bear breakout of a bull flag. So bull breakout, bull flag, and then a surprise bear breakout. But look at bar 53. What leg is bar 53? It might be leg 3. 1, 2, 3 pushes down. And of course, there's an obvious big tail on the bar, and that shows there was a lot of buying into the close of the bar. So not ideal for a bear breakout. It's enough price movement that there might be a minor second leg, but because it's a late leg, 3 legs down after a strong trend, and this is probably an overall trading range. This is probably low in the range, and selling here can be dangerous. So big bear breakout bar, but big tail, and then bad follow through, and more bad follow through. Low one short, but bad context, and then a bad entry bar, going a little lower, but buyers below here. Bears disappointed. Some bear who sold the low tick of 53, maybe they sold more below 56. And there's their average price, the low of 59. So let me state that again more clearly. When bar 53 was on its low, there was a sense of urgency, and a trader may have sold at the market when the bar was on its low, only for the market to close way up here, and suddenly they're trapped into a losing trade. And then you get a reversal bar, 56, maybe you scale in, sell more below that bar. So if you sold the low tick of bar 53, sold more below 56, the red line is your average price. That's your cost average. And at that point, you're probably so disappointed in the sell down here that you'll take break even on the entire trade. And that's where 59 retested. And you can see every bear in the world. I say that jokingly. But you can see we tested that 50% level and then everybody bought. Strong enough breakout 60. It's a double bottom. Maybe it's a head and shoulders bottom. Probably going to get a second leg up. Deep pullback, but still probably going at least a little bit higher. Going more sideways, the market is in a trading range, and you can call it a triangle. Lower highs, higher lows, the market's getting squeezed. But again, after such a strong rally, this is more likely a bull flag. The trading range has gone on long enough that the breakout direction is more 50-50 than it was over here. But there is an upside bias because of this rally. This is all minor, and we still will probably get a retest of the bull trend's extreme. The market likely has to retest the close of bar 29. By the close rally, traders who bought here did something reasonable, and if they use a wide stop and scale in, they'll probably be able to avoid a loss, and not only avoid a loss, but make money. If you bought the close of 29, bought more above 44, there's the average price. Got a little bit above it, but then we sold off. It's the same idea I talked about over here. So we're in a triangle, in the apex of a triangle, trying to get a bull breakout and follow through with a magnet above, but getting late in the day. 73 climactic bar, breaking out above the bull trend extreme, but at this point the market is in a trading range. Think about Al's 80% rule. 80% of breakouts of trading ranges fail, so this will likely fail. No follow through. 74, a little bit of a dangerous bar. This should still get a second leg, but when you have a bear bar closing on its low at the top of a trading range, it might be better to get out of longs. And that's the problem right there, 75. Still, this will probably get a second leg, but the risk is real that we pull back very deep here. In this case, we got a second leg, and then we fell back into the range. I know these days, these situations are tricky. The market looks like it's a leg in a trading range, but it just goes on. And it can be really hard to buy, and you can easily get trapped on the sidelines. And that's why having an always an approach can really help. Because if you look at the context from yesterday, the market's always in long, and it never became always in short in here. So in theory, you can buy above bar 2 today. Maybe you don't trade the first 6 bars. You wait for, even if you wait for a breakout and follow through here, 18, 19. Just buy the close. The market's rallying with very shallow pullbacks, so okay to buy the close. The market is trending up. And having an always in approach can help avoid getting trapped out of a trend like this. And then having a simple exit strategy, like if the market is far from the moving average and you're getting consecutive buy climaxes, the risk is big. At this point, what's the trader's equation for the bulls? You're buying the close of 29, stop below 25, 1-to-1 is all the way up here. The reality is you're getting so far from the average price, at some point you're going to pull back. And if you get a bar closing below its midpoint, like I said earlier, it might just be better to get out below it and reassess. Or you wait for 31, get out below 31. And then here, big up, big down, you start to trade it more like a trading range. So buy low, sell high, and scalp. Stop order trades today. I thought you could buy above 2. And again, based on the always in argument, buy above any bull bar closing above its midpoint here. So bar 2, you could have a stop order above 5, 11, 14, 16, 18, buy the close 19, buy any of these bars. It's technically buy the close all the way up, but again, there is a default exit below bar 30. And I would not sell on a stop below 30. It's aggressive. Some traders will, and it's reasonable, but personally, that's not my trade when you're getting this much buying. High 2, 35, but tight channel. It's a tight 2 legs down. We didn't trigger the buy anyway, but that was not a great stop order buy. And then when you get 35 and a brief second leg, there's an argument to be made selling below 40, but it's a doji. You're expecting a second leg down, 1, pull back 2. It's just a scalp, but really not great. Bad signal bar and strong bull trend completely above the moving average. If you take the trade, you scalp out really quickly. That's what happened here. 44 was a reasonable buy, 45 reasonable. But where do you get out? There's resistance here. And when the market starts going sideways here, you might be disappointed. Get out below a second reversal. So maybe not 48, but get out below 51. The market rallied, sold off, rallied again above 50 on 51, sold off again. Traders will get out below that bar. Some traders would buy above 55, bull bar closing on its high after 3 legs down. Use a wide stop, be willing to scale in. Some traders will buy above 59. Even though it's a doji, it closed above its midpoint, it's a double bottom, and again, the context is pretty good. Bull breakout 60 and a brief second leg, but that wasn't really symmetrical. 60 will probably get a more symmetrical second leg, and it's common to see breakouts get brief second legs only to pull back and then get a more symmetrical second leg. So I thought buying 69 was okay, 70 better, higher probability. Bull bar closing on its high, maybe buy the close 71, breakout and follow through of a triangle after a bull trend with a magnet above that will probably get retested, but probably get out below 74. And then 78 was a reasonable stop order sell, but so late in the day might not be worth it. Today we had a small pullback trend that converted into a trading range in the second half of the day, a little more before the second half of the day. And where do we go tomorrow? Tight trading range and overall trading range on the daily chart. A couple of bull bars and the market's attempting to break out. And it closed above this high, but the bulls now need follow through. And if this was a strong breakout of a trading range, why were there sellers into the close of the bar? And why did the market not race up and close on its high? So a little suspicious. Strong enough breakout for a second leg, but because it's an overall trading range, the pullback could be deep. So we may get disappointment tomorrow for the bulls. So maybe go sideways tomorrow and then find a deeper pullback. Maybe retest the breakout point. the high of October 7th. Bad buy signal bar, but we got a rally out of it. All right, that's all the time I have for today. Thanks everybody for watching, and I hope everyone has a good night.